Nobody plans to sell their investments at a bad price, but it happens all the time. Not because people panic, but because they run out of choices. Maybe the boiler dies, maybe the tax bill lands, maybe the only spare cash is sitting in investments that have just fallen in value. And later in this video, I'll show you a real UK fund where investors could no longer choose when to take their money out, and where the final payments weren't completed until June 2026, about 2 years and 8 months after dealing was suspended. That's a risk investors often overlook. It isn't only what the market does, it's whether your plan leaves you with choices when you actually need the money. So let's look at how to reduce the risk of being forced to sell. Welcome back to Money Under the Microscope, making finance clear. I've been advising people on exactly this kind of decision since 2016 as a chartered financial planner. A lack of accessible cash is a planning problem that can often be avoided. Here's the first line of defence, a cash buffer. MoneyHelper, the UK's free government-backed money guidance service, suggests keeping 3 to 6 months of essential outgoings in an instant access savings account. Not invested, just there. But, and this matters, MoneyHelper says it may be cheaper to deal with debts like high-interest credit cards, unauthorised overdrafts, payday loans or mortgage arrears before building a full emergency fund. A cash buffer doesn't help much if it's sitting next to debt charging you more than it earns. Here's why the buffer matters so much. Say you need £10,000 and your investments are worth £10 a unit. You sell 1,000 units. Simple. Now imagine the market's fallen 20% first. Your units are worth £8 each. To raise the same £10,000 you need to sell 1,250 units instead. That means selling 25% more units before any tax or charges that might apply, simply because the price was lower when you needed the money. A cash buffer doesn't guarantee you'll never be forced to sell, but it gives you more choice over when and whether you need to sell. So when you do need to sell something, how do you choose what? This applies whether it's a general investment account or an ISA. There's no official order, no always sell this account first rule, but there are 6 questions worth asking every time. 1. How much cash do you actually need? 2. Which of your holdings can you sell in time? 3. If the investment is outside an ISA, would selling create a taxable gain or a loss? 4. For 2026-27, individuals have a £3,000 capital gains tax annual exempt amount. After any allowable losses, would the gain fall within that amount or exceed it? 5. If you take money out of an ISA, could you lose tax-sheltered space, or is that particular ISA flexible? And 6. What would selling do to the rest of your portfolio, and what does it actually cost to sell? Run through those 6 and you'll make a far better decision than any generic rule could give you. Just a quick interruption guys, if this is helping please do hit the subscribe button. I break down exactly this kind of real world money planning every few days, not just the tax headlines. Right, let's get back to the video. One more thing most people never think about. Not every investment can be sold at the same speed. Think of it like a ladder. Cash in an instant access savings account, usually available the same day subject to the account terms. Eligible deposits are protected by the Financial Services Compensation Scheme up to £120,000 per person per authorised firm if that firm fails. A money market fund, usually dealt daily, but it's an investment, not a bank deposit. It doesn't get the same FSCS protection, and access depends on the fund and platform's dealing terms. Listed shares and mainstream funds, generally sellable on normal dealing days, but the cash doesn't land instantly. Settlement and withdrawal processing both take time. Some structured products may have limited early exit options, while employer share schemes can restrict dealing to set windows. And further down the ladder, physical property and some open-ended property funds, these can take months to sell, and some funds have suspended withdrawals entirely. So, how do you actually use the ladder? Match your money to your timeline. Money you expect to need in the next few months is generally better matched to cash or easy access savings. Nothing clever. Money you're unlikely to need for at least 5 years may be suitable for investing, depending on your goals, circumstances, and ability to accept losses. 5 years gives investments more opportunity to ride out short-term falls, and it doesn't guarantee that they will. Check the position at least once a year or when things change. That one check, matching what you hold to when you'll actually need it, is the habit that keeps you off the wrong end of that ladder on the day it matters. Now, here's that fund I promised you at the start. In October 2023, M&G suspended dealing in its property portfolio fund. In M&G's own words, the office buildings and warehouses it owned cannot be sold quickly to accommodate sudden large withdrawal requests. Investors could no longer choose when to redeem their holdings. M&G returned the property sale proceeds through 9 numbered capital repayments, followed by a separate final payment in June 2026. That was about 2 years and 8 months after dealing was suspended. It had been a daily dealing ISA eligible fund, but daily dealing did not mean access was guaranteed. So here's the real takeaway. Forced selling isn't only about what the market does, it's about whether your planning leaves you with choices. Know your timeline, keep a buffer, ask the right questions before you sell, and know where your money sits on the ladder before you need it. None of this means don't invest, it means investing with a plan for the day you may need the money. This is Money Under the Microscope, making finance clear. If this has helped, please do subscribe and tell me in the comments which of these would actually change what you do next. See you on the next one, guys.